Transfer pricing rules and the arm's length principle. Transfer pricing rules are designed to regulate the prices at which transactions occur between related parties and connected persons. These rules are essential for ensuring that the price of a transaction is not manipulated due to the relationship between the parties involved. In essence, transfer pricing seeks to prevent tax avoidance strategies where entities may artificially shift profits between jurisdictions to reduce their overall tax liabilities, or manipulate prices in a way that benefits certain related parties at the expense of the tax base. The purpose of transfer pricing rules. The primary objective of transfer pricing rules is to ensure that transactions between related parties or connected persons are priced in a manner consistent with what would occur between independent, unrelated parties. The aim is to prevent parties from setting prices for goods, services, or financial arrangements in such a way that artificially minimizes taxable income or shifts profits to jurisdictions with lower tax rates, thereby depriving governments of rightful tax revenue. The arm's length principle. At the core of transfer pricing is the arm's length principle, an internationally recognized standard for determining the appropriate pricing of transactions between related or connected parties. According to this principle, arm's length transaction. A transaction is considered to be at arm's length if the terms and conditions of the transaction, including the price, are the same as those that would have been agreed upon between independent parties in similar circumstances. Purpose of the arm's length principle. The goal is to ensure that transactions between related or connected parties are not influenced by their relationship, and that the pricing is not skewed in a way that allows profits to be shifted across borders or among entities within the same corporate group in a manner that avoids taxes. For instance, if a company sells goods to a subsidiary, the price at which these goods are sold must reflect the price that would have been agreed upon if the subsidiary were an unrelated entity. In this way, the transaction mirrors a typical market transaction, ensuring that the profits from the sale are accurately recorded in the relevant jurisdiction, preventing the shifting of profits to locations with more favorable tax treatment. Applicability of transfer pricing rules. Transfer pricing rules are applicable to both cross-border and domestic transactions and are enforced for transactions carried out by both juridical persons, legal entities, and individuals. 1. Cross-border transactions. When transactions occur between related parties in different countries, the transfer pricing rules help ensure that the prices are set according to the arm's length standard. This is particularly important to prevent profit shifting between jurisdictions, which could result in tax base erosion in higher tax countries and the unjust advantage of lower tax jurisdictions. In the case of cross-border transactions, the transfer pricing rules often need to be aligned with international standards, such as those established by the Organization for Economic Cooperation and Development, OECD. These guidelines promote transparency and help prevent multinational enterprises from exploiting differences in tax laws across countries. 2. Domestic transactions. Transfer pricing rules also apply to transactions conducted within a single country between related entities. Even if the transactions occur within the same tax jurisdiction, they still need to adhere to the arm's length principle. This is because entities within the same corporate group may still attempt to manipulate prices to shift profits and reduce their overall tax liability, even without crossing borders. For example, if a parent company in one part of a country sells goods or services to a subsidiary in another part of the country, the transfer price must reflect what would have been agreed upon in an independent transaction. Key aspects of transfer pricing regulations. 1. Documentation and reporting. Both cross-border and domestic transactions subject to transfer pricing must be properly documented. This includes maintaining detailed records that show how transfer prices were determined in accordance with the arm's length principle. These records are important for the tax authorities to assess whether the pricing used is consistent with market practices. Taxpayers may be required to prepare transfer pricing documentation to substantiate their compliance with the arm's length standard, and this documentation should be made available for inspection by tax authorities when requested. 2 methods for determining arm's length prices. The transfer pricing rules provide several methods for determining the appropriate arm's length price. These methods include: comparable uncontrolled price (CUP) method compares the price of a similar product or service in an open market transaction between unrelated parties. Resale price method involves determining the resale price of a product after deducting a reasonable margin for the seller. Cost plus method determines the price based on the cost of production plus an appropriate profit margin. Transactional net margin method (TNMM) compares the net profit margin earned in a related party transaction to the net margin earned in similar transactions between unrelated parties. Profit split method splits the total profit from a transaction between related parties based on the relative contributions of each party. 3 adjustments by tax authorities. Tax authorities, upon reviewing the pricing and related documentation, have the right to make adjustments if they find that the prices set between related or connected parties are not at arm's length. These adjustments may include increasing the taxable income of one or both of the related parties involved in the transaction. The goal is to ensure that the profits reported by the entities align with the actual economic value generated by the transaction and reflect the fair market conditions. 4. Impact of transfer pricing adjustments. If a tax authority adjusts the transfer pricing, the adjusted profit must be reported in the jurisdiction where the transaction was conducted, ensuring that the profits are taxed appropriately. In some cases, the related party involved in the transaction may also be able to make a corresponding adjustment to its taxable income to avoid double taxation. 5. Prevention of profit shifting. The transfer pricing rules are a critical tool for tax authorities to prevent profit shifting, a practice in which multinational companies artificially allocate profits to low-tax jurisdictions through manipulated transfer prices. By adhering to the arm's length principle, companies help ensure that their profits are properly taxed in the jurisdictions where economic activities occur, rather than being shifted to places with favorable tax rates.